Hi friends, today we're going to see about monetary economics. Introduction. Monetary economics is a branch of economics that provides a framework for analyzing money and its functioning as medium of exchange, store of value and unit of account. It examines the effect of monetary systems including regulations of money and associated financial institutions. Now we are going to see about money. Meaning, money is anything that is generally accepted as payment for goods and services and repayment of debts and then services as made of exchanges. As the medium of exchange is anything that widely accepted as a means of payment. In recent years, the importance of credit has increased in the countries of world. Credit instruments are used as an intensive scale. The use of checks, bills of exchange, etc. has gone up. It should, however, be remembered that the money is the basis of credit. Evolution of money. The introduction of money as a medium of exchange was one of the greatest inventions of mankind. Before money was invented, exchange took place by barter. That is, commodities and services are directly exchanged for other commodities and services. Under the barter system, buyers and sellers of the commodities had to face number of difficulties. Surplus goods were exchanged for money, which in return was exchanged for other needed goods. Goods like furs, skins, salt, rice, wheat, utensils, weapons, exchange of goods was known the barter exchange or barter system. Metallic stand. After the barter system and commodity money system, modern money systems involved. Among these, metallic standard is a premier one. Under metallic standard, some kind of metal, either gold or silver, is used to determine the standard value of money and currency. Standard coins made out the metal are the principles of coins used under the metallic standard. These standard coins are full-bodied or full-weighted legal tender. Their face value is equal to their intrinsic metal value. Gold standard. Gold standard is a system in which the value of monetary unit or the standard currency is directly linked with the gold. The monetary unit is defined in purchasing power of a unit of money is maintained equal to the value of a fixed weight of gold. Silver standard. The silver standard is the monetary system in which the standard economic unit is account is fixed of the weight silver. The silver standard, the purchasing power of the unit of money is maintained equal to the value of mixed weight of gold. Silver standard. The silver standard is a monetary system in which standard economic unit of account is fixed weight of the silver. The silver standard is a monetary arrangement in which a country's government allows a conversion of its currency into fixed amount of silver. Paper currency standard. The paper currency standard refers to the monetary system in which The paper currency notes issued by the Treasury or the central bank of both circulate as unlimited legal tender. Paper currency is not convertible into any metal. Its value is determined independent of the value of gold or any other commodities. The paper standard is also known as the managed currency standard. The quantity of money in circulation is controlled by the monetary authority to maintain the price stability. Plastic money. The latest type of money is plastic money. Plastic money is one of the most involved forms of financial products. Plastic money is alternative to the cash or the standard money. Plastic money is the term that is used predominantly in reference to the hard plastic cards used every day in the place of actual banknotes. Plastic money can come in many different forms such as cash cards, credit cards, debit cards, prepaid cash, and store cards, forex cards, and smart cards. They aimed at removing the need for carrying cash to make transactions. Cryptocurrency. The digital currency in which the encryption techniques are used to regulate the generation of units of currency and verifying the transfer of funds operating independently of a central bank. Digital cryptocurrencies such as Bitcoin now provide an outlet for primary functions. Now we can see the types and primary functions. Money as a medium of exchange and money as a measure of value. Now we can see money of medium of exchange. This is considered as a basic function of a money. Money as the quality of general acceptability, and all exchanges takes place in terms of money. On account of the use of money, the transaction has now come to be divided into two parts. First, money is obtained through the sale of goods and services. This is known as sale. Later, money is obtained to buy goods and services. This is known as purchase. Thus, in the modern exchange system, money acts as an intermediary in the sale of and purchase. Money as a measure of value. The second important function of money is measure the value of goods and services. In other words, the price of all goods and services are expressed in the terms of money. Money is thus looked upon a collective measures of a value, since all the values are expressed in terms of money. It is easier to determine the rate of exchange between the various types of goods in the community. Secondary functions. Money as a store of value is the first part. Savings done in terms of commodities were not permanent. But with the invention of money, this difficulty has now disappeared and savings are now done in the terms of money. Money also serves as an excellent store of wealth, as it can be easily converted into the other marketable assets such as land, machinery, plant, etc. Money as a standard of deferred payments. Borrowing and lending were difficult problems under the barter system. In this absence of money, the borrowed amount could be written only in terms of goods and services. But the modern money economy has greatly facilitated the borrowing and lending process. In other words, money now acts as a standard of deferred payments. Money as a means of transferring purchasing power. The field of exchange also went on extending with the growing economic development. The exchange of goods is now extended to the distant lands. It is therefore felt necessary to transfer the purchasing power from one place to another. Contingent functions. Basis of the great credit system. The money is the basis of credit system. Business transactions are either in cash or on a credit. For example, a depositor can make use of checks only when there are sufficient funds of his account. The commercial banks create credit on the commercial basis of adequate cash reserves, but money is at the back of all credits. Money facilitates distributions of national income. The task of distribution of national income was exceedingly complex under the barter system, but the inventions of money has now facilitated the distribution of income as rent, wage, interest, and profit. Money helps to equalize the marginal utilities and the marginal productivities. Consumer can obtain the maximum utility only if he incurs expenditure on various commodities in such the manner as to equalize the marginal utilities occurring from them. Now, in equalizing these marginal utilities, money plays an important role because the prices of all commodities are expressed in money. Money also helps to equalize marginal productivities of various factors of production. Money increases productivity of a capital. Money is the most liquid form of capital. In other words, capital in the form of money can put any use. It is on account of liquidity of money that capital can be transferred from the less productive to the more productive uses. Other functions. Money helps to maintain the payments of capacity. Money possesses the quality of general acceptability to maintain its replacement and repayment capacity. Every firm has to keep assets of form of liquid cash. The firm ensures its repayments capacity with money. Likewise, banks, insurance companies, and even governments have to keep some liquid money to maintain the payments of capacity. Money represents generalized purchasing power. Purchasing power kept in terms of money can be put to any use. It is not necessary for that money should be used only for the purpose of which had been served. Money gives liquidity to capital. Money is the most liquid form of capital. It can be put at any use. Now we can see the supply of money. Money supply means the total amount of money in an economy. It refers to the amount of money which is in circular in an economy at given time. Money supplies plays a crucial role in the determination of price level and interest rate. Money supply viewed at the given point of time in stock and over a period of time, it is a flow. Now we can see the meaning of money supply. In India, currency notes are issued by the Reserve Bank of India (RBI) and coins are issued by the Ministry of Finance, Government of India (GOI). Besides these, the balance is saving or current account deposits held by the public in a commercial bank is also considered money. The currency notes are called the fiat money and the legal tenders. Money supply in a stock variable, RBI published information for 4 alternative measures of money supply, namely M1, M2, M3 and M4. M1 is currency, coins and demand deposits. M2 is M1 plus savings, deposits with the post office saving banks. M3 is M2 plus time deposits of a commercial and cooperative banks. M4 is M3 plus total deposits with the post offices. M1 and M2 are known as a narrow money. M3 and M4 are known as a broad money. The graduations are decreasing order and the liquidity. Determinants of money supply. Currency deposit ratio CDR. It is the ratio of money held by the public in the currency to their hold in the bank deposits. Reserve deposit ratio RDR. Reserve money consists of 2 things: A. Vault cash in banks and B. Deposits of a commercial bank RBI. Cash reserve ratio CRR. It is the fraction of deposits the bank must keep with RBI. Statutory liquidity ratio SLR. It is the fraction of total demand and time deposits of a commercial bank in the form of specialized liquid assets. Now we are going to see the quantity theories of money. Quantity theories of money explain the relationship between the quantity of money and the value of money. Here we are given 2 approaches of quantity theory of money: Fisher's transaction approach, cash balance approach. Fisher's quantity theory of money. The quantity theory of money is very old theory. It was first propounded in 1588 by an Italian economist, Davandasti, but the credit for popularizing this theory in recent years rightly belonged to the well-known American economist Irving Fisher, who published this book, The Purchasing Power of Money, in 1911. He gave it a quantitative form in the terms of famous equation of exchange. The general form of equation given by Fisher is MV equals to PT, where M equals to money supply, quantity of the money, V is velocity of the money, P is price level, T is volume of transactions. Fisher points out the country during a given period of a time, the total quantity of money, MV, will be equal to the total of goods and services bought and sold, PT. MV equals to PT, supply of money equals to demand for money. This equation is referred to the cash transaction equation. It is expressed as P equals to MV by T, which implies the quantity of money determines the price level, and the price level in the terms of varies directly with the quantity of money, provided V and T remain constant. The above equation considers only currency money, but in the modern economy, Banks demand deposits or credit money, and its velocity play a vital part in a business. Therefore, Fisher's extend his original equation of exchange to include bank deposits M1 and its velocity V1. The revised equation was, from the revised equation it is evident that the price level is determined by the quantity of money in circulation M, the velocity of a circulation of money V, the volume of a bank credit money M1, the velocity of the circulation of credit money V1, the volume of trade T. Dramatic illustrations. The effect of changes in the quantity of money of the price level. When the quantity of money is OM, the price level of the OP. Cambridge approach, cash balance approach. Marshall equations. The Marshall equation is expressed as M equals to KPY, where M is the quantity of money, Y is the aggregate real income of the community, P is the purchasing power of the money, K represents the fraction of real income which the public desires to hold in the form of money. Thus, the price level P equals to M or Ki or the money value. The reciprocal of a money level is 1 by P equals to Ky by M. The value of money in the terms of this equation can be found out by dividing the total quantity of goods which the public decide to hold, the total income by the total supply of money. According to Marshall's equation, the value of money is influenced not only by changes in M, but also by changes in K. Keynes equation. Keynes equation is expressed as N equals to Pk or P equals to N by K. N is the total supply of money. P is the general price level of consumption of goods. K is the total quantity of consumption units the people decide to keep in the form of cash. Keynes indicates that K is the real balance because it is measured in terms of consumers' goods. According to Keynes, people's desire to hold money is unlimited by the monetary authority. So, price level and the value of money can be stabilized through regulating quantity of money by the monetary authority. Later, Keynes extended his equation in the following form. N equals to P, K plus RK, or P equals to N by K plus RK, where N equals to total money supply, P equals to price value of consumer goods, K equals to people's desire to hold money in hand in terms of consumer goods in the total income of them, R equals to cash reserves ratio, K equals to community's total money deposit in banks in terms of consumer goods. In this extended equation also, Keynes assumed that K, K1 and R are constant. In this situation, price level P is changed directly and proportionally changing in a money volume. Inflation. Both inflation and deflation of evils of economy, so understand of these is essential. Meaning of inflation. Inflation is a constant and appreciable rise in the general price level. In other words, inflation is the rate at which the general price for goods and services is rising, and consequently the purchasing power of the currency is falling. Types of inflation on the basis of speed. Creeping inflation, walking inflation, running inflation. Fourth, galloping inflation or hyperinflation. The four types of inflations are indicated. Creeping inflation. Creeping inflation is slow moving and very mild. The rise in price will not be perceptible, but speed over the long period. This type of inflation is in no way dangerous to the economy. This is also known as a mild inflation or a moderate inflation. Walking inflation. When a price rises moderately and annually inflation rate is a single digit, 3%, 9%, it is called walking or trolling inflation. Running inflation. When a price rises rapidly like running of the horse at a rate of 10% to 20% per annum, it is called running inflation. Galloping inflation. Galloping inflation is or a hyperinflation points but to unmanageably high inflation rates that run into a 2 or 3 digits by high inflation percentage of the same is almost 20% to 100% from an overall perspective. Demand pull versus cost push inflation. Demand pull inflation. Demand and the supply play a crucial role in deciding the inflation levels in the society at all points of a time. For instance, if the demand is high for a product and supply is low, the price of a product increases. Cost push inflations. When the cost of raw materials and other inputs rises, the inflation results. Increase in wages as paid to a labor also lead to inflation. Wage price spiral. Wage price spiral is used to explain the cause and effect of a relationship between the rising wages and rising prices or inflation. Other types of inflations on the basis of inducement. Currency inflation. The excess supply of money in a circulation causes rise in the price level. Credit inflation. When the banks are liberal in lending credit, the money supply increases and thereby raising the prices. Deficient induced inflation. The deficient budget is generally financed through printing of a currency by a central bank. As a result, prices rise. Profit-induced inflation. When the firms aim at higher profit, they fix the price with a higher margin, so prices go up. Scarcity-induced inflation. Scarcity of a goods happens either due to a fall in the production, example farm goods, or due to the hoarding and black marketing. This also pushes up the price. This has happened in Venezuela in the year 2018. Tax-induced inflation. Increases in the indirect tax like excise duty, custom duty and sale tax may lead to rise in the price. Example, petrol and diesel. This is also called taxflation. Causes of inflation. The main causes of inflation in India are as follows. Increase in money supply. Inflation is caused by an increase in a supply of money which leads to increase in aggregate demand. The higher the growth rate of the nominal money supply, the higher is the rate of inflation. Decrease in disposable income. When the disposable income of the people increases, it raises their demand for the goods and services. Disposable income may increase with the rise in national income or reduction in the taxes or reduction in the saving of people. Increase in public expenditure. Government activities have been expanding due to the developmental activities and social welfare programs. This is also cause for the price rise. Increase in consumer spending, the demand for goods and services increases. When they given a credit to buy goods and higher purchase and installment basis. Cheap money policy. Cheap money policy or the policy of credit expansion also leads to the increase in the money supply, which raises the demand for goods and services in the economy. Deficient financing. In order to meet its mounting expenses, the government resorts to deficient financing by borrowing from the public and even by printing more notes. This raises a aggregate supply, thereby leading to the inflationary rise in prices, black assets and activities and money. The existence of black money and black assets due to corruption, tax evasion, etc. increase the aggregate demand. People spend such money lavishly. Black marketing and hoarding reduces the supply of goods. These trends trend the rise of the price level further. Repayment of public debt. Whenever the government repays, it's a past eternal debt to the public. It leads to the increase in the money supply with the public. This tends to raise the aggregate demand for goods and services. Increase in exports. When exports are encouraged, domestic supply of goods declines, so price rise. Effects of inflation. The effects of inflation can be classified into two heads: effects on production and effects on distribution. Now we can see effects of production. When the inflation is very moderate, it acts as an incentive to traders and producers. This is particularly prior for full employment when the resources are not fully utilized. The profit due to rising prices encourages and induces business classes to increase their investments in the production, leading to generation of employment and income. However, hyperinflation results in the serious depreciation of a value of the money and it discourages savings on the part of public. When the value of money increase the aggregate demand, people spend such a money lavishly. Black marketing and hoarding reduces the supply of goods. Thus, trends tend to raise the price level further. Repayment of public debt. Whenever the government repays its past internal debt to the public, it leads to the increase in the money supply with the public. This tends to raise the aggregate demand for goods and services. Increase in exports. When exports are encouraged, domestic supply of goods decline, so prices rise. Effects of inflation. Effects of inflation can be classified into two. One is effects on production and effects on distribution. Now we can see effects on production. When the inflation is very moderate, it acts as an incentive to the traders and producers. This is particularly prior to full employed when resources are not fully utilized. The profit due to rising prices encourage and induces the business class to increase their investments in production, leading to the generation of employment and income. However, hyperinflation results in a serious depreciation of the value of money and it discourages savings on the part of public. When the value of money undergoes considerable depreciation, this may even drain out for the foreign capital already invested in the country. With reduced capital accumulations, the investments will suffer a serious setback that may have an adverse effect on the volume of production in the country. This may discourage entrepreneurs and businessmen from taking business risk. Inflation also leads for hoarding of essential goods both by the traders as well as a consumer, and thus leading to the still higher inflation, etc. Inflation encourages investment in speculative activities rather than the productive purposes. Effects on distribution. Debtors and creditors. During inflation, debtors are the gainers while the creditors are losers. The reason is that debtors had borrowed when the purchasing power of money was high and now repaid the loans when the purchasing power of the money and low due to rising prices. Fixed income groups. The fixed income groups are the worst hit during the inflation because their relationship with the rising of a cost of living. Examples: wage, salary, pensions, interest, rent, etc. Entrepreneurs. Inflation is a boon to the entrepreneurs whether they are manufacturers, traders, merchants, or businessmen, because it deserves a tonic for business enterprise. They experience a windfall again as the price of the investors suddenly go up. Investors. The investors who generally invest in fixed interest yielding bonds and securities have much to lose there during inflation. On the contrary, those who invest in shares to gain by rich dividends and appreciations in value of shares. Measures to control inflation. Keynes and Milton Friedman together suggested 3 measures to prevent and control of inflation. 3 measures are monetary measure, fiscal measure, and the other measures. Monetary measures. These measures are adopted by the central bank of country. They are increase in bank rate, sale of government securities in the open market, higher cash reserve ratio (CRR), and saturated liquidity ratio (SLR), consumer credit control, and higher margin requirements. Sixth, higher repo rate and reverse repo rate. Fiscal measures. Fiscal policy is now recognized as an important instrument to tackle an inflationary situation. The major anti-inflationary fiscal measures are the following: reduction of government expenditure, public borrowing, and enhancing the taxation. Other measures. These measures can be divided broadly into a short-term and long-term measures. Short-term measures can be regarded to the public distribution of the scarce essential commodities through the fair price shops. In India, whenever a shortage of a basic goods has been felt, the government has resorted to the import so that inflation may not to be triggered. Long-term measures will require accelerating economic growth, especially of the wage goods, which have a direct bearing on the general price and the cost of living. Some restrictions on a present consumption may help in improving saving and investment, which may be necessary for accelerating the rate of economic growth in the long run. Now we can see the meaning of deflation, disinflation, and stagflation. Deflation. The essential feature of the deflation in falling prices, reduced money supply and unemployment. Through falling prices are desirable at the time of inflation. Such a fall should not be lead to the fall of in the level of production and employment. But if prices fall from the level of full unemployment, but both income and employment will be adversely affected. Disinflation in the slowing down the rate of the inflation by controlling the amount of credit, bank loan, higher purchase available to the consumers without causing more unemployment. Disinflation may be defined as the process of reversing inflation without creating unemployment or reducing output in the economy. Stagflation is a combination of stagnant economic growth, high unemployment and high inflation. Trade cycle. The economic activity in the capitalist the study of these ups and downs is called the study of business cycle or trade cycle or industrial fluctuations. Meaning of trade cycle. A trade cycle refers to the oscillations in aggregate economic activity, particularly in employment, output, income, etc. It is due to the inherent contractions and expansions of the elements which energize the economic activity of the nations. The influctuations or the fluctuations are periodical, differing in the intensity and the changing on its coverage. Definition. A trade cycle is composed of periods of good trade characterized by rising prices and low unemployment percentages, altering with the periods of bad trade, characterized by falling price and high unemployment percentage. This is said by J.M. Keynes. Phases of trade cycle. The four different phases of a trade cycle is referred to as boom, recession, depreciation and recovery. These are illustrated. Now we can see the boom and prosperity phase. The full employment and the movement of the economy beyond the full employment is characterized as a boom period. During this period, there are hectic activity in the economy. Money wages rise, profit increase and interest rates go up. The demand for bank credit increases and there is all around the optimism. Recession. The turning point from boom condition is also called recession. This happens at higher rate than what was earlier. Generally, the failure of the company or bank bursts the boom and are drastically reduced. Production comes down and incomes and profits decline. There is panic in the stock market and business activities show signs of dullness. Liquidity preference of the people rises and money market becomes tight. Depreciation. During depression, the level of economic activity becomes extremely low. Firms incur losses and closure of business becomes a common feature and the ultimate result is unemployed interest places. Profits and wages are low. The agriculture class and wage earners would be worst hit. Banking institution will be reticent to the advanced loans to businessmen. Depression of the worst phase of the business cycle extreme because it is a deep point in the business. Any person fell down in deeps could not to be come out from the without others help. Similarly, in economy, fell down in through the could not come out from the without external help. Keynes advocated that autonomous investment of the government alone can help the economy to come out from the depression. Recovery. After a period of depression, recovery sets in. This is turning point from the depression to revival towards the upswing. It begins with the revival of demand for capital goods. Autonomous investment boosts the activity. The demand slowly picks up and due to the course the activity is directed towards the upswing with more production, profit, income, wages, more and employment. Recovery may be initiated by innovation or investments or by government expenditure, autonomous investments. We can see the summary. Currency is created by the RBI and union governments. Bank deposits are created by commercial banks and cooperative banks. The demand for money is determined by the number of factors such as income, price level, interest rate, etc. Financing introduction. Finance is the life of blood. All economic activities such as trade, commerce, agriculture and industry. A bank is generally understood as an financial services such as accepting deposits and lending loans. Banking sector acts as the backbone of modern business world. The banking system significantly contributes for the development of any country. Due to the importance in the financial stability of the economy, banks are highly regulated in the most countries. Historical developments. The risk banks of Sweden, which had sprung from the private bank established in 1656, is the oldest central bank in the world. It acquired the sole right of note issue in 1897. But the fundamentals of the art of banking have been developed by the Bank of England in 1864 as the first bank of issues. A large number of central banks were established between 1921 and 1954 as a compliance with the resolution passed by the International Finance Conference held at Brussels in 1920. The South African Reserve Bank 1921. The Central Bank of China 1928. The Reserve Bank of New Zealand is 1934. The Reserve Bank of India 1935 and the Central Bank of Ceylon is 1950 and the Bank of Israel is 1954 were established. Commercial banks. Commercial bank refers to the bank or a division of large bank which more specifically deals with the deposit and loan, specifically services provided to the corporation or large middle-sized business as opposed to individual members of the public small business. They do not provide long-term credit as the liquidity of assets is to be maintained. Functions of commercial bankings. Commercial banks are institutions that conduct business with a profit motive by accepting public deposit and lending loans for various investment purposes. The functions of commercial banks are broadly classified into primary functions and secondary functions, which are shown. Functions are commercial banks. Primary function, accepting deposits. It implies the commercial banks are mainly dependent on the public deposits. There are two types of deposits which is discussed as follows. Demand deposits. It refers to the deposit that can be withdrawn by individuals without any prior notice to the bank. In other words, the owners of these deposits are allowed to withdraw the money anytime by writing a withdrawal slip or a check at a bank counter from an ATM centers using a debit card. Time deposits. It refers to the deposits that are made for a certain committed period of time. Banks pay higher interest on the time deposits. These deposits can be withdrawn only after the specific time period by providing a written notice to the bank. Advancing loans. It refers to the granting loans to individuals and businesses. Commercial banks grant loans in the form of overdraft, cash credit, and discounting bills of the exchange. Secondary functions. The secondary functions can be classified under three heads, namely agency functions, general utility functions, and other functions. Agency functions. It implies that commercial banks act as the agents of customers by performing various functions. Collecting checks. Banks collect checks and bills of the exchange of the behalf of their customers through clearinghouse facilities provided by the central bank. Collecting incomes. Commercial banks collect the dividends, pensions, salaries, rents, and interest on the investments on behalf of their customers. A credit voucher is sent to the customers for information when the income is collected by the bank. Paying expenses. Commercial banks make the payments of various obligations of customers, such as telephone bills, insurance premium, school fees, and rents. Similar to the credit voucher, a debt voucher is sent to the customers for information when expenses are paid by the bank. General utility function. It implies that commercial banks provide some utility services to customers by performing various functions. Providing locker facilities. Commercial banks provide a locker facilities to the customer for saving custody of jewelries, shares, debentures, and other valuable items. This minimizes the risk of loss due to the theft at homes. Banks are not responsible for the items in the lockers. Issuing travelers' checks. Bank issues travelers' checks to the individuals for traveling outside the country. Travelers' checks are safe and easy way to protect money while traveling. Dealing in foreign exchange. Commercial banks helps in providing foreign exchange to businessmen dealing in exports and imports. However, the commercial banks need to take the permission of a central bank for dealing the foreign exchange. Transferring funds. It refers to the transferring of funds from one bank to another. Funds are transferred by the means of draft, telephonic transfer, and electronic transfer. Letter of credit. Commercial bank issues letter of credit to the customers to certify the creditworthiness. Underwriting securities. Commercial banks also undertake the task of underwriting securities as the public has full faith in the creditworthiness of banks. Public do not hesitate in buying the securities underwritten by banks. Electronic banking. It includes the services and as debiting cards, credit cards, and internet banking. Other functions. Money supply. It refers to the one of the important functions of a commercial banking and the help in increasing money supply. For instance, of bank lends 5 lakh to an individual and opens and demand deposits in name of the individual. Bank makes a credit entry of 5 lakh in that account. This leads to the creation of demand deposits in that account. The point to be noted here is that there is no payment in cash. Thus, without printing additional money, the supply of money is increased. Credit creations. Credit creation means the multiplication of loans and services. Commercial banks receive deposits from the public and use these deposits to give loans. However, loans offered are many times more than the deposits received by the banks. This function of banks is known as credit creations. Collection of statistics. Banks collect and publish statistics relating to the trade, commerce and industry. Hence, they advise customers and the public authorities on the financial matters. Mechanism, techniques of credit creation by commercial banks. Bank credit refers to the bank loans and advances. Money is said to be created when the banks, through their lending activities, make a net addition to the total supply of money in the economy. Likewise, money is said to be destroyed when the loans are repaid by the borrowers to the bank, and consequently the credit already created by the banks is wiped out in the process. Banks have the power to expand or contract demand deposits, and they exercise the power through granting more or less loans and advances and acquiring other assets. This power of commercial bank to create a deposit through expanding their loans and services is known as credit creation. Primary passive deposit and derived active deposit. The modern banks create the deposits in two ways. They are primary deposit and derived deposit. When the customer gives cash to the bank and bank creates a book in his name called the deposit, it is known as a primary deposit. But when such a deposit is created without there being any prior payment of equivalent cash to the bank, it is called derived deposit. Credit creation literally means the multiplication of loans and advances every loan creates in its own deposits. In a central bank insists the banks to maintain a ratio between the total deposits they create and the cash in possessions. For the purpose of understanding, it is assumed that all banks are obliged to keep us the ratio between the cash and its deposits is a minimum of 20%. The banks do not keep any excess reserves, in other words. It would exhaust possible avenues out of income earning activities like giving loans, etc., up to the maximum extent after the attaining the minimum cash reserves. There are no drains in the supply of money. The public do not suddenly want to hold more ideal currencies or withdraw from the time deposits. Under the above assumption, when a customer deposits a sum of ₹1,000 in a bank, the bank deposits of ₹1,000 in his favor. Bank deposits, bank money have increased by 1,000. But at this stage, there is no increase in the total supply of money with the public, because the above extra bank of money is ₹1,000 is affixed by the cash of ₹1,000 deposit in the bank. The bank has now additional cash of ₹1,000 and its custody. Since it is required to keep only cash reserves of 20%. This means that rupees 800 is excess cash reserves with it. The bank has now additional cash of the rupees 1000 and its custody. Since it is required to keep the reserves of a 20%, that means 800 in excess cash. The total deposits will now grow into the 1000 rupees, 800 rupees plus 640 rupees and other amounts ultimately can excess the cash reverse peters out. Role of commercial banks in economic development of the country. Capital information. Banks play an important role in capital formation, which is essential for the economic development of the country. They mobilize the small savings of the people scattered over a wide area through the network of branches all over the country and make it available for the productive purpose. Nowadays, banks offer very attractive schemes to induce the people to save their money with them and bring the savings mobilized to organized money. If the banks do not perform this function, savings either remains idle or used in creating other assets which are low in scale of planned priorities. Creation of credit. Bank create credit for the purpose of providing more funds for development. Projects. Credit creation leads to increased production, the employment, sales and prices are thereby they bring about faster economic development. Channelizing the funds towards the productive investments. Banks invest the saving mobilized by them for productive purposes. Capital formation is not only a function of a commercial banks. Pooled savings should be allocated to various sectors of the economy with a view of to increase the productivity. Then only it can be said to be have performed an important role in the economic development. Encourages right type of industries. Many banks help in the development of the right type of industries by extending loan right type of persons. In this way, they help not for industrialization of the country, but also for economic development of the country. They grant loans and advances to manufacturers whose products are in great demand. The manufacturers in turn increases their products by introducing a new methods of production and assist in raising their national income of the country. Sometimes subprime lending is also cloned. That is how wherever an economic crisis in the country is 2007 to 08 in the US.